Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Gleason with Money Metals Exchange, and you're about to hear the explosive conclusion of our exclusive two-part interview with Jim Rickards, renowned monetary, financial warfare, and geopolitical expert, and author of two best-selling books, The Death of Money and Currency Wars, and now a new book titled The Big Drop, How to Grow Your Wealth During the Coming Collapse. Jim pulls no punches when I ask him about the state of the U.S. economy, the Fed's response, and what it is all likely to mean for gold, and how everyday investors can protect themselves against what may be in store for us in the days ahead. Turning the focus here to some of the current economic issues domestically, I find it quite interesting how the mainstream media and the president both continue to trumpet the idea that we're experiencing this great recovery, but you've made the point that governmental and, more importantly, Fed policy hasn't allowed for a real recovery because they never let the market correct itself after the '08 collapse. Explain what you mean.
Sure. We're not in a normal cyclical recovery. Now, I'm almost the only person in the world who is saying that. Everyone else, certainly the talking heads on television and financial TV and the White House and everywhere else you go say, well, we're having this great expansion. We're creating a lot of jobs. Crisis is over. Stock markets are reaching all-time highs. When I come along and say, well, we're in a depression, and my view is we are in a depression, people look at me like I have two heads, like, what are you talking about? It's happy days are here again, everything's going up, and where are the soup lines? You're supposed to have soup lines in a depression. So let me explain. A normal cyclical recovery, which we've seen, 30 or more times since the end of World War II, the way it works is the economy gets a little overheated, unemployment goes down, job market gets tight, inflation starts to pick up a little bit, and the Fed looks at that and they worry about it getting out of control, so they tighten interest rates. That cools things down, unemployment goes up, prices level off, interest rates come down, and then it kind of hits bottom, and then the Fed says, okay, time to dial it up again, and then they ease, and then we go back up again. So it's a nice sine wave, goes up and down, over and over, and it's just like the thermostat in your house. The house is too cold, you dial it up. House is too warm, you dial it down, and somehow you try to keep it on an even keel, but you've always got that thermostat if you need to adjust things, and the thermostat is the Fed. That's a normal business cycle, a normal credit cycle. Bull and bear markets track that, with some leads and lags. That's the environment that everybody's familiar with. That's not the environment we're in. We are not in a normal self-sustaining cyclical recovery. If we were, we would have had much stronger growth by now, and the Fed would, interest rates would be 2-3%, maybe higher. Inflation would be higher. A lot of things would be very different than they are right now. We're in a depression. What is a depression? People say, well, the technical definition of recession is 2 consecutive quarters of declining GDP with rising unemployment and a few other bells and whistles. And their intuition says, well, a depression sounds worse than a recession, and if a recession is 2 quarters of declining GDP, a depression, that must be like 10 quarters of declining GDP. It must be really bad. And we have not experienced that. The economy has, in fact, expanded continuously since 2009. But that's not the definition of a depression. You can have growth in a depression. You can have a rising stock market in a depression, and indeed we did. You go back to the Great Depression. The Great Depression lasted from 1929 to 1940, and yet in the middle of that, from 1933 to 1936, the stock market did great. 1933, 34, that was one of the best periods in the stock market in history, and the economy is expanding and unemployment is coming down exactly the way it is now. But there were structural problems that we never got away from, and then in 1937 the whole thing fell off a cliff again, and it wasn't really till World War II, in 1940-41, when the U.S. started getting involved and retooling, restructuring the economy to go on a war footing, that we really escaped from the Great Depression, but of course it took the Second World War. Now, bringing that today, the definition of a depression is not that you have declining growth. It's that you have a long period of growth below potential. That's the definition of a depression. So potential growth in the United States in the long term is about 3.5%. Short-term growth could be 4 or 5% because you have a lot of factors, a lot of labor factors and underutilized factors, industrial capacity and things that could be brought in to get higher growth in the short run, which is exactly what we saw in the early days of the Reagan administration, 83 through 86, the U.S. economy grew 16% in 3 years. That was banging out, over 5% a year during that 3-year stretch. So we're capable of 4 or 5% growth in the short run. We're capable of 3.5% growth for a very long period of time. We're actually getting 2% growth. It's the gap between 3.5 and 2, or between 5 and 2, depending on how you want to measure it, that is depressed growth. And so that's what we're experiencing. We have growth, but it's weak. It's way below trend. It's way below potential. And if you think the difference between 2 and 3, or 2 and 3.5 doesn't sound like a lot, that's not true. A 1.5% difference compounded over 35 years, one economy will be almost double the other. That 3.5%, 4% economy will be twice as rich, twice as wealthy, twice as well off as the 2% economy after 35 years, which is, kids are born, they go to college, they get a job, and 35 years have gone by, and one economy is twice as rich as the other. So that's the difference between trend growth or potential growth on the one hand and depressed growth on the other. So that's what we're in. As far as the soup lines, we have soup lines. They're at Whole Foods. In other words, we have 51 million Americans on food stamps, but when you get food stamps today, it's like a debit card. You get an electronic payments card from the government, and you can just go swipe it at any cash register, and so you can buy your soup at Whole Foods. You don't need to line up at the local soup kitchen. So, there's a lot less here than meets the eye in terms of growth, in terms of the hardship Americans are suffering. So under these definitions that I'm describing, by the way, that definition of continuous growth below trend, neither collapse nor trend growth, but something below trend for a long period of time, that's Maynard Keynes' definition. I think it's a good one. I use it myself, and that's what I mean when I say we're in a depression, but I didn't come up with that. That's Maynard Keynes. And by the way, the example of this is Japan. Japan has been going through this since 1990. So if you want to understand the United States economy today, we are Japan. Japan is now in a 25-year depression going back to 1990. The United States is in the same depression. Ours started in 2007. So we're 8 years into it. Maybe we have 17 to go, but we look like Japan.
Can the Fed raise rates in this environment? I mean, they would have to know what would happen if they did, which would be short-term economic pain, something they seem to refuse to stand for, right?
Well, no, I wouldn't assume that at all. So you're assuming, Mike, that the Fed knows what they're doing, but they don't. I've spoken to Fed governors, I've spoken to regional Reserve Bank presidents, I've spoken to a lot of senior officials at the Federal Reserve and insiders there. They don't know what they're doing. They won't say it publicly, but they do say it privately. This is one big science experiment. They try something. If it seems to work, they try a little more. If it doesn't work, they change it up. We've had 15 different policies since 2008. When you go through, interest rate cuts, QE1, QE2, QE3, Operation Twist, forward guidance in 7 different flavors, currency wars, nominal GDP targeting, taper. I mean, you name it. They change policy every couple of months. So they have no idea what they're doing. So to answer your question, could they raise interest rates? They could. They certainly are signaling that. They have given markets no reason to believe that they're not going to raise rates. And they keep talking about it, and recently Janet Yellen, Stan Fisher all gave speeches on this. So everything the Fed is doing indicates that they do plan to raise rates later this year. However, they've given up on forward guidance when they took out the word patience at the last FOMC meeting. That was the end of forward guidance. They're just flying blind. They say they're data dependent, okay, but remember, data is at best real time. And at worst, it's very lagged because you get the data on a certain day, but it's talking about something that happened 2 or 3 months ago. So when you're data dependent, at best you're kind of looking in the rearview mirror. You're not really looking ahead at this cement wall you're about to crash into. Now the way to look ahead is with forecasts, okay, but to do a forecast you need a model. And the Fed models are all flawed. The Fed, by the way, has the worst forecasting record of any institution I can think of. Go back over the last 6 years. Every year, the Fed does a one-year forward forecast. So in 2009, they have a forecast for 2010. In 2010, they have a forecast for 2011, and so on. And today, they have a forecast for 2016. Well, guess what? They have been wrong 6 years in a row by orders of magnitude. They've been wrong by a lot. I'm not talking about saying 2.9 and it comes in 2.8. That's fine. I mean, that's a bullseye as far as I'm concerned. I'm talking about saying 3.5 and it comes in 1.9, or lowering it to 3 and it comes in at 2.1. Those are errors of large orders of magnitude in terms of what the Fed's doing. So data dependent doesn't help you very much unless you have good forecasting models, and the Fed doesn't. So they have no idea what they're doing. So to answer your question, could they raise rates? Sure. Will they? Let's hope not, because if they do, I mean, they're going to crash markets around the world. They're going to crash emerging markets. They're going to crash junk bond markets, probably crash the stock market, because the economy is very weak. My models show we're going to have very weak growth in the first quarter, probably continuing into the second quarter. Yeah, people talk a lot about job creation. That's fine. I'm glad people are getting jobs, but these are not high-paying jobs. These are not real wages are not going up. Household incomes are not going up. All the things you need to drive a consumer economy are not happening. So the answer is, let's hope that the Fed sees the data in time to avoid a train wreck. Let's hope that they stop looking in the rearview mirror and start looking out the windshield and see what's coming ahead. But they may not. You don't want to be massively short the stock market, because they could wake up one day and start to signal QE4 early next year. That wouldn't surprise me, in which case markets could actually rally on that news. But they're not there yet. I call that blinking. The Fed hasn't blinked yet. They're still talking. What they're doing, they're trying to have it both ways. They're talking tough and doing nothing. Talking tough and doing nothing, which is kind of the worst of both worlds, because the tough talk has spooked the markets, but doing nothing occasionally causes the markets to rally. So you get this non-directional volatility, up one day, down the next. Again, I think it's a good reason to own gold. I recommend 10% of your portfolio allocated to gold, because it's going to preserve wealth. It's going to see it through thick and thin. Dollar price of gold fluctuates a little bit. I know gold bugs like to see gold go to the moon. I think it will eventually, but not yet, not right away. I mean, we got a lot to work through first. But I'm sort of encouraged by the fact that commodity prices have collapsed. We see oil down, we see copper down, iron ore. You look at the commodity index; it's completely imploded. But gold hasn't. Beginning late last year, gold diverged from the index. Gold is part of the index, but normally they're highly correlated. So when the commodity index is going down, gold is going down. But what happened late last year is that the commodity index continued to crash, but gold broke away and went up a little bit and kind of leveled out a little bit, but it's not crashing. It's not going up a lot. But, why isn't gold at $800-900 an ounce, which is where it would be if it had tracked the commodity index? Well, the answer is people are starting to think of it as money instead of a commodity, which is the right way to think about it. I know the dollar price isn't going up a lot, but to me it's showing a lot of strength, because the dollar price of everything else is collapsing. So given all this uncertainty, given all this volatility, one more reason to own gold.
Well, Jim, it has been a tremendous honor to speak with you today, and we're huge fans of yours and have been for a long time. Before I go, I want to tell our listeners that we have lined up for them a way to get a copy of your new book, The Big Drop, How to Grow Your Wealth During the Coming Collapse. It's fantastic stuff, and you will not be disappointed if you take advantage of that. Well, Jim, thanks very much. Thanks for being so generous with your time. It was great speaking with you.
Thank you, Mike.
Below this podcast is a link that enables our listeners to sign up for this new book, along with a risk-free trial of Strategic Intelligence, a newsletter that you do not want to miss. I strongly encourage our Money Metals customers and all podcast listeners to jump on this opportunity right away. You won't be disappointed. Well, that will do it for this week. Thanks again to Jim Rickards, author of Currency Wars, The Death of Money, and now The Big Drop, How to Grow Your Wealth During the Coming Collapse, and editor of the Jim Rickards Strategic Intelligence newsletter. Check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.